It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. And now today, I'll tell you what, today, folks, we have a very exciting guest today. We have Russell Bolton with Coastal States Bank. Russell, welcome to the show.
Ference, thanks for having me. Happy to be here.
Now, I'll tell you what, folks, those of you that have been listening to the show know that we set up high cash. One of the things that Your Personal Bank concept is really all about is setting up high cash value policies to maximize cash growth, maximize dividends. And then what we recommend people do is then set up a bank line of credit. The cash and the policy is the collateral for the loan. And then you access funds through the bank line. And the key point is, you get to keep the difference. The dividends is higher than the interest you're getting charged. You keep the difference. That's the positive arbitrage. What I'm excited about Coastal States is, real simple, is that we found a better interest rate. Isn't that right, Russell?
Yes, sir. We have a very competitive floor rate. Our floor rate is currently at 3.25%. That's one of the unique things about our program. And then also, a very important, unique thing about our program is the loan to value that we'll offer on the cash value.
Yes, I thought that was excellent too. So, what is the loan to value that you can do, Russell?
For individual borrowers that have credit scores 750 or higher, we will actually offer 100% loan to value on the cash value, which is unique to Coastal States Bank.
I think that's unique in the country as far as I'm aware.
Yes, sir. I haven't found any other bank or insurance company that will offer 100% loan to value on the cash value.
Exactly. So, folks, what that means is whatever cash value you have available in your policy, what Russell is saying is Coastal States will offer up to 100% of that in a bank line as long as you have the credit score for it. Correct?
Yes, sir. Yes, sir. That's correct. As long as your credit score is 750 or higher, we'll give you access to 100% of your cash value.
Well, you can't beat that. That's for sure.
It's hard to go over. We won't go over 100. I don't know anybody that would do that.
I don't either, of course, obviously. Mm-hmm. Now, the other thing I was going to say is, the standard on whole life policies I found for most banks is around 95% typically. And on variables, it can be somewhere between 50 and 75%. Do you have some parameters in those areas?
Yes, sir, we do. So we will accept variable whole life policies at a 75% loan to value, and we will accept universal life and index universal life policies. It's a little bit different, though. For universal life and index universal life policies, they'll need to come with a whole life policy. So that's kind of a different thing about our program is we like them to come with a whole life policy, and typically the loan to value on a universal life or index universal life is going to be around 50%. Okay.
And actually that fits in a lot with what I do with clients. I mean, I know there's a big it's a big argument, I should say, in the industry about whether, IUL is better, whole life is better or whatnot. And my point I've been making for years, literally, is it's all typically I find it's more preference with the agent than it is with the client. In other words,
you're exactly right.
Yeah,
it's whatever the agent is used to working with and really feels comfortable putting out into the marketplace. So it's more the agent that you go to. You're exactly right, than the client decides.
Yeah, and I found we're one of the very few, if not about the only out there, it seems like, that does both. And we'll do both. We'll do them interchangeably. And, in fact, I'll have clients sometimes that'll do both right up front because there are strengths and weaknesses with a whole life policy, the guarantees being one of them, the steady, consistent dividend growth is the other. But there's strengths and weaknesses to the IULs, the index universals. They have more upside potential, but you have years you could see no gains, right?
Exactly right. And so they're all, what I tell people is they're all great products.
They are. They all have a place.
And there's a fit for them in the marketplace. And it's really the client. And a lot of times you'll see clients have a whole life policy and an IUL policy and have them for different purposes. So it's really what the client is trying to accomplish with the policy.
And I do exactly. Oftentimes I recommend that because a lot of times I'll run numbers on both. For example, with a client, because they're not real sure which way they want to go. And I said, well, let me throw one more curveball at you. Why, if they're on the fence, right? I said, well, nobody said you had to do all of one or all the other. Why don't we split it up and do some in one and some in the other? And they're like, oh.
Oh, I didn't realize you could do that.
Exactly. And so I always share this very thought. Modern portfolio theory, which has been around forever, it seems like, talks about a 60-40 split with stock, bond type, portfolio mix, right? Because you want some potential growth with some safety and consistency. Why not apply the same principle here?
You're exactly right. Maybe have some more aggressive growth in an IUL policy, and the safe, kind of fixed portion of your portfolio or of your insurance portfolio, to put quotes around it, be in the whole life policy.
Yeah, exactly.
And I always recommend, don't put all your eggs in one basket. I mean, you don't have to put all of your money into one policy. A lot of times you'll see people that have multiple policies and for different reasons. And if not for the reason that their income situation and their cash flow has changed and their income's grown over the years, so they bought multiple policies throughout the years.
Yeah, and that's the other thing often people are surprised by. I have multiple policies. I've been doing this about 7-8 years myself. And I have different ones for different purposes, some for personal, some for our business and various things. And, as we've grown and developed more income and things like that, it actually opens up more opportunities because literally with premiums and things like that, if premium has come due on one policy and maybe you don't have the funds at that moment, but you got cash in another one, you could actually access them through the bank line with you guys and fund the premium on the other one for a while, right?
Exactly right. It's exactly right. And we see clients do that a lot. Just if their insurance changes and they need more death benefit and they are looking for a quick place to find some premium dollars, the line of credit's sitting right there and it's available. And so a lot of times they'll dip into that line of credit to get the new policy started.
And by the way, I'm glad you brought that up, because one of the big questions I get all the time is, well, how easy is it to access my money from the line?
Incredibly easy on our end. So we're going to give you every way to access it under the sun at Coastal States Bank. So you'll get checks and you'll be able to write checks directly from your line of credit. You'll also have access to online banking. So you'll be able to move funds electronically through online banking if you choose to do that. And then we can always send wires for you. And we don't charge fees for wires.
Oh, wow.
From lines of credit. So everything you could think of is you'll have the access on your line of credit.
Yeah, I tell people all the time, you've had a bank account, right? And they're like, well, yeah, it's that easy.
It's that easy. You're exactly right. What I compare it to is anybody who's ever had a home equity line of credit against their house. This is like a home equity line of credit against your life insurance.
Yeah, you're exactly right. It's the same principle.
Same concept.
Yeah, the cash in the policy is the collateral for the loan, so it's a collateralized loan, correct?
That's exactly right. We call it cash value line of credit, but just for comparison's sake, a lot of times people will say, "Oh, that sounds kind of like my home equity line of credit." So that's why I use the home equity line of credit as a comparison.
Right. Actually, I did get a question today, in fact, Russell. I didn't get a chance to ask you this. So you mentioned 100% access to the funds if the credit score is 750 or higher. I have a couple that her credit score is like 800, his is like 720. How does that work?
That's a great question. So there's in that situation, a lot of times what I'll recommend is if you're really trying to get the 100% loan to value,
right,
then you can put the line of credit in your spouse's name that has the higher credit score.
Okay.
And essentially what the other spouse who's not a party to the line of credit will do is they'll sign what we call a hypothecation agreement or a third-party pledger agreement. And what that agreement says is I own this policy, but I'm going to use it for my spouse's line of credit. So the ownership doesn't change on the policy. You're just saying that I'm going to use the policy that I own for my spouse's line of credit. That way we could give them the 100% for the higher credit score, if that makes sense.
So bottom line is you still own it. You're just using the spouse with the higher score to get the access to more money.
Exactly. That's exactly right. It's a simple document, and we do this all the time for clients.
Okay, yeah. I said, yeah. I was driving into the studio, and he asked me that question. I said, I'm interviewing Russell this afternoon. I'm going to ask him that question.
That's a great question. It happens more often than you would think, and we're happy to do that for clients so they can get access to 100%.
So the other thing, question I get oftentimes is, so somebody's interested in they have a policy, they have the cash value in it, they want to set. What's the process of setting up and getting qualified for a line?
That's a great question. We're going to make it as easy as possible on not only the agent, but specifically the client. We want to make this quick and easy and painless for people. So our process is a one-page fillable PDF application. You can fill it out on your computer. You can print it and sign it either way. And you send that back to me along with your policy statements. And typically, I'm having people approve within 24, 48 hours. So it's a really simple approval process.
And does this, another good question I get on this is, does this impact like loan to, so if somebody's doing other lending, like say they're a real estate investor and they're actively with their business, does this affect the loan to equity ratio, or you know what I'm saying? Loan to income ratio,
yes.
I'm sorry.
Yeah, your debt to income.
Debt to income, thank you.
You bring up a great point. So there's two ways that we designate these lines of credit.
Okay.
One is for a consumer purpose, and the other is for a business purpose.
All right.
Now, if you designate the line of credit for a consumer purpose, the line of credit will show up on your credit report, and it will affect your debt to income.
Okay.
Now, that can be a benefit if you pay down your balance on your line of credit and there's not much being used on the line of credit. Sometimes that can help your credit score because you've got a bunch of open credit available.
I see.
If you're using it for a business purpose, and you want to designate it for a business purpose, there are benefits to doing it that way as well. The biggest benefit is designating this line of credit for a business purpose means that it will not be reported to the credit bureaus and it will not show up on your credit report. So it does not affect your debt to income.
So basically, folks have the option.
Go ahead.
So bottom line is the folks have the option.
Exactly. And it's a preference call. Whichever you think it's going to help you best is the way that you should go to designate it, either consumer or business. One important thing about the business, designating it for a business purpose is, say, we do see a lot of people using this for real estate investing.
Yes.
Now, it's on the client's end to track how they use the funds. We're not going to track how the client uses the funds, but if the client tracks how they use the funds for that real estate investment purpose or for that business purpose properly, and they talk to their CPA, a lot of times the interest expense on that portion of the funds can be deductible.
Yes, I've shared that with folks many times, that if it's used for business purpose, oftentimes it can be a deductible expense. The interest can be a deductible expense.
That's correct. So
we're going to hang on. I'm going to encourage folks to stay on in the next segment because Russell and I are going to talk more about these bank lines of credit and how they work with the policies and how you can gain that positive arbitrage and put more money in your pocket. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we have a special guest. We have Russell Bolton with Coastal States Bank, and we have an exciting announcement. Again, any of our listeners know that Your Personal Bank concept is really about setting up a high cash value policy designed to maximize cash growth, maximize dividends or interest, depending on what type of policy we're talking about. Now, again, this is not the type of insurance policy most people are familiar with. We're not focusing on maximizing death benefit protection, although there is some there, don't get me wrong. Our focus is really about maximizing cash and cash growth. But most importantly, why we bring the banks into the picture here, and I'm going to have Russell share with us more here in a second, is when you access the funds through the bank line of credit versus taking it directly from the policy, you oftentimes can benefit from positive arbitrage. And I've shared on the show many, many times that we have companies paying 5.75 to 6% dividends today, have been paying those dividends for the last 25 plus years. I have the charts. I can show you the history, and have never missed a dividend since literally before the Civil War. Folks, that's powerful. So if you're making 5.75 to 6% dividends, and then you access it through the bank line of credit, and Russell, what's your current rate on a bank line of credit?
So our rates are tiered anywhere from, they're pegged to Wall Street Journal Prime.
Okay.
And they're tiered anywhere from Prime minus 50 basis points to Prime minus 1.25, 125 basis points. So that would be Prime minus 0.5% to Prime minus 1.25%, depending on the size of the line.
Okay.
And now we do have the floor rate, which is 3.25%, and the floor rate applies across the board. But depending on the size of your line, the variable rate spreads are really aggressive. So we would, based on what interest rates are doing right now and where we expect them to go, we would expect most people to be sitting at our floor rate of 3.25 for the next couple of years.
Right. So the point, I guess, Russell, you're making is if you're earning somewhere between 5.75 and 6% dividend today, and that's depending on which company we go with, what's the best fit for you, and then you access the funds from the bank line, and you're getting charged 3.25, the floor rate right now, which would probably be for most people, right?
Yeah. Yes, sir.
Then you're keeping the difference, aren't you?
Yes, the money's working for you in your policy, and that powerful arbitrage is happening where you're getting paid to use your money somewhere else.
Exactly, and a point I make, and in fact, our last the next show interview that you're going to hear is going to be very powerful. I've got one of my clients who's been using this for over a decade. Look, if you can get your money to work twice for you, why not?
Exactly.
Yeah.
So, especially if it's in a guaranteed tax deferred asset.
Yeah. So if you're picking up that difference, and by the way, most of my clients today are picking up somewhere around the 2.5, some upwards 2.75 range of positive arbitrage.
Wow.
Yes.
That's powerful. That's a win-win-win for the client.
And that isn't, and Russell, that isn't this year. That's every single year. So,
and you talk about the law of compounding.
Exactly.
That really significantly adds up over time.
Exactly. I mean, one of the things I share all the time is somebody, this is Money Radio. We have a lot of listeners who are investors. And I often say, look, what's your average rate of return? And I'll hear all kinds of numbers. But if it's 7% or 10% or whatever they give me, real estate investor, stock market investor, whatever, crypto investor, I don't care what it is. They tell me what their average rate of return is. Look, if it's 10%, you add 2.5 to that, that's a 12.5% return on your money, right?
Right.
That's a 25% increase.
Better?
Yeah, that's a 25% increase on your average rate of return, and you're not doing anything. I mean, your money's working twice for you. It's not like you need extra money to do it. It's the same dollars.
Right. You're exactly right.
And it's the power of using the insurance tool and the banking tool together. I kind of call it's like a marriage. They work together, and they're both better because of it.
Right, and there's a reason why banks are one of the largest owners of life insurance in the United States. They understand the concept.
I share that quite often, and there's a lot of people are surprised by that, but there's a whole industry or a type of product called BOLI, or bank-owned life insurance.
Yes, sir. And banks own a ton of it because they understand the value of the guaranteed asset growing at X amount, right, and then lending it out at another rate.
Yeah, banks make money off the positive arbitrage.
That's exactly right.
And so what we try to do is we try to educate folks, individuals, businesses, whatever, that you can take advantage of the positive arbitrage just like a bank does with your money.
On a personal level.
Correct.
You're exactly right.
And again, it's all about earning more in dividends than you're getting charged in interest when you access the money.
And that's the beauty of the cash value line of credit is coming in at a lower interest rate. And the most important point is the lower interest rate on the cash value line of credit. But there's other benefits that come along with the cash value line of credit, like the ease of access and being able to be in control of that purse of money instead of having to reach out to the insurance company every time you want to access it.
Right. And like we mentioned in the first segment, folks, if you missed it, go to yourpersonalbank.com. You can check out the previous segment or any of our previous shows for that matter. But we talked about that in the last segment, the ease of access. I mean, how easy is it to access this money, Russell?
It is real easy to access it. I mean, with Coastal States Bank, you're going to have access to online banking. You can access at any point in time you want through online banking. You'll also have checks, so you'll have the ability to write checks. And we can also send wires for you whenever you need a wire done. And
you even mentioned there's no cost for the wires, too. Is that right?
Yes, we do. We do not charge for wires from lines of credit.
I have never heard of that, so that's awesome.
Yeah, That may be unique to us. I didn't realize that, but that may be unique to us.
It might be. And since you brought up what's unique, the other thing I find unique, I mean, your floor rate's 3.25. That's very competitive today. But you also have access to how much of the funds?
100% of your cash value for individual borrowers with credit score 750 or higher.
Exactly. So, again, I believe that's unique in the country. I've never heard that either.
Yes, I haven't come across a bank or an insurance company that'll do that. That's unique to us. And matter of fact, we get a lot of business because of that.
And I imagine you do because we've already mentioned some of the number one users of this tool happen to be real estate investors because they need and want access to funds for their real estate investing. Yes. What are some other uses you see?
We see a lot of different uses across the board. One of the uses that I see a lot is sometimes families using the cash value line to pay tuition for education expenses. Another thing I see a lot is retirees. Mm-hmm. So kind of the old school retirement mentality for baby boomers was you put your money into your 401k and you max out your 401k, and then you're going to draw it out when you retire. Well,
right.
What we've learned by watching the baby boomers retire is, you don't own 100% of that 401k.
Right.
Depending on your tax bracket, you only own 70% of it.
Right.
And so it costs you $1.33 to pull out $1 of spending power from your 401k plan.
Exactly.
Well, a lot of times these retirees are saying, well, I'm not ready to start pulling out of my 401k. I want to let my 401k keep accumulating.
Mm-hmm.
Well, then they go to their life insurance bucket. So they're letting the money stay in their 401k plan, and they're using the cash value line of credit to supplement their income while the market is just growing like crazy and their 401k continues to grow instead of pulling it out early in retirement and having to pay that $1.30, if that makes sense.
Russell, I'm so glad you shared that because that's a very key point I've been making with clients and with folks for quite some time and on the radio show is, and then the other point that you didn't bring up, that, and I want to talk about this further in the next segment, is, you mentioned you need $1, if your tax bracket's at 30%, you need $1.33 for every dollar to keep. What if tax rates go higher
right.
in the future?
Yeah, exactly right.
Yeah, and
it's going to eat. You own less and less of your 401k.
Right. So, folks, I'm going to encourage you to stay tuned in the next segment. We're going to talk about this further, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and we have a great guest and a special guest today, Russell Bolton with Coastal States Bank, and we've really been talking a lot about the bank line of credit aspect of the Your Personal Bank concept. Again, as I share with people all the time, and those who have been listening, we set up high cash value policies designed to maximize cash growth, whether we do it steady Eddie through dividends or indexing with upside potential, double digits in good years and no downside in the bad years. And then we set up a bank line of credit because you can access funds directly from a policy. You have that option. But if you choose to access it through a bank line, most of the time you can get a better or lower rate. And like I said, with the dividend rates, the companies we're working with today are still paying 5.75 to 6% dividends today. Been doing so the last 25 plus years. Never miss a dividend since before the Civil War. But, Russell, what are the current rates with Coastal States if they do this for you guys?
So right now our floor rate is 3.25%. So everybody and our rates are pegged to prime, and Wall Street Journal Prime is currently 3.25%. So whether you've got a $50,000 line with us or a $10 million line with us, everybody is borrowing at our 3.25% floor rate right now.
Okay. And actually, that was another good point you brought up. We haven't brought up yet is what size of lines, what's the ranges that people can do with Coastal States?
So that's a great question. So right now our minimum marketed line is $100,000. Mm-hmm. Now, if you have a special need and you've got $50,000, $60,000 in cash value and you're going to use the line of credit, I would say send us an application, send us your policy statement, and we'll take a look at it and help you get that done.
Okay.
But we go. Our marketed minimum to 100,000 goes all the way up to $2.5 million for the same simplified underwriting.
Okay.
One-page application and policy statements. We will go above $2.5 million, but there's a little bit. It's same process, but we're going to ask probably for more documentation for over $2.5 million, probably a personal financial statement and maybe 2 years of tax returns.
Okay, that sounds great. And like I said, so bottom line is, if you're earning 5.75 to 6% dividends, let's say, in a high cash value whole life policy today, and you then access those funds through the bank line, and you're getting charged 3.25%, well, you're keeping the difference, right?
Yep, that money's sitting there waiting for you in your life insurance policy,
which can do anything from pay expenses, supplement retirement, pay for college, whatever, right?
Pay for a family vacation, whatever you can think of.
and by the way, setting up these bank lines, what's involved?
Very simple process. It's a one-page application. It takes about 2 minutes to fill out, and that will pull your credit as a part of the approval process. And I think we mentioned before, for credit score 750 or higher, we'll offer 100% loan to value on the cash value. And then for credit scores 625 to 749, we'll be at 95% loan to value.
So somebody's going to get access to 95 to 100% of their money, depending on their credit score.
Depending on their credit score, that's exactly right. So one-page application and policy statements, and typically I can have people approved within 24 or 48 hours.
And the access to the funds, once they have it set up?
We'll give you every way to access it that you can. You'll get a checkbook with the line of credit. You'll get access to online banking where you can move funds around electronically if you choose to do that, and then we can also send wires for you when needed.
And you told me those wires are free.
Yep, those wires are free.
Yeah, that's unique. The 100% loan to value is I believe, unique also. And, again, folks ask me all the time, how easy is it? Well, have you ever operated a bank account? It's that easy.
It's that easy. My goal is to make it as quick and easy for you to access the funds as possible. That's what we're here to do.
Russell, I even have people, I've had folks do that. Well, this whole bank line thing sounds interesting because, their main focus is they just want to grow their money, right? So they like the idea of getting the dividends or whatever. So they put their money there and it's growing. It's got safety. It's got tax benefits, all that fun stuff. Right. And they're like, this bank line thing sounds interesting, but, I don't really think I have any plans of pulling it. And I'm like, you should set it up anyway because just in case, gosh, you have a checkbook. Right?
This is a no. If you have enough cash value in your whole life insurance policy, there is no reason not to have the cash value line of credit as a part of your financial plan. There are no fees to set up these lines of credit. This is a bucket of liquidity to have available for you. You can access it instantly for when anything comes up, for when that investment opportunity comes up, for whether you're starting a business, whether you have a kid going to college.
You have an
Whatever
emergency.
you can think of, this bucket's going to be there.
I tell people this all the time. A lot of people have some funds set away for emergency funds, and we all need to have that. But I also point out, there's no reason. Nobody said you had to sit in the bank and earn no interest.
Exactly right.
Emergency money just needs to have two factors: safe and liquid. Well, this has both of those qualities.
Yes, you could use a portion of the funds sitting in your life insurance policy as your emergency fund if you've got the line of credit because you can access it instantly.
Exactly. Same day. You could have it wired even, like you said. That fast.
Exactly.
Awesome. Well, I'm going to encourage folks to stay tuned because Russell and I are going to talk about further about this retirement idea, how to enhance your retirement earnings and make sure you have more money to help you not run out of money in retirement. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're going to wrap this show up today, but we've had a great guest today, Russell Bolton with Coastal States Bank. Russell, I just really want to thank you for joining us today.
Absolutely. Thank you for having me, Ference. This has been a great opportunity. I'm happy to be here.
That's awesome. That's awesome. And the reason I asked Russell to join us, if you haven't listened, you didn't missed the previous segments, boy, folks, I'm going to really encourage you to go to yourpersonalbank.com and check out this show. And again, you can listen to any of the previously recorded shows, actually. But Russell has been doing a great job of explaining how the bank line of credit really fits in hand in glove with setting up a high cash value policy to grow your money and have access and gain positive arbitrage. And so, again, I want to thank Russell for doing that. And just real quick, bottom line is we set up high cash value policies to maximize growth, and the dividends or the interest you're earning is typically higher than what you're getting charged. The bank lines with coastal states, currently the rates are?
Our floor rate is currently 3.25%, and our variable rates are pegged to Wall Street Journal Prime, and depending on the size of the line, they're anywhere from Wall Street Journal Prime minus 0.5% to Wall Street Journal Prime minus 1.25%.
So bottom line, folks, if you're earning 5.75 to 6% dividends on a whole life high cash value policy, or we have index policies that have averaged 8.5% over the last 25 years, I can show you the numbers. By the way, that's set up correctly, tax-free with downside guarantees. And then you access those monies through the bank line of credit, and you're getting charged 3.25%. You're keeping the difference, aren't you?
That's exactly right. That is exactly right. That money will be sitting in your life insurance policy waiting for you to access it.
Right, and that could supplement retirement or pay bills or do anything else you want it to do. The bottom line is you have more money in your pocket, folks, and that's really what the personal bank concept is about. And the last thing, we really haven't touched on this. This is what I want to touch on. Then one other thing is the key takeaway. I always share this with folks, and I want them to understand this. Look, if you put money in the policy and it's earning dividends or interest, it's growing, it's doing its thing, that's great. That's one thing. But when you access it from the bank line and the interest is charged is less than what you're earning, so you're keeping the difference, like we said, that's positive arbitrage. Here's the key takeaway. Folks, that's on money you spent.
Right.
It's not, this isn't an either or, should I invest in this or invest in that to get a better rate of return? It's about, show me, and Russell, I haven't seen it, another way where someone can earn interest on money they actually literally spent.
I can't think of any other way there is. The cash value line of credit is really the only way I can think of that you can access money that is working for you in your life insurance policy and invest it or spend it somewhere else.
Right, and still pick up some interest. And like I said, most of my clients right now are getting about 2.5 to 3, upwards of 3% positive arbitrage on those dollars. And
absolutely, depending on the insurance company. You're exactly right.
And they're not even, and again, they spent the dollars aren't even in their control anymore. They actually took them and, they're in the policy, still earning dividends or interest. But they, like I said, took the money, because I say when you access funds, you access them from the insurance company or the bank. You're accessing them from the bank, right?
That's correct. That's exactly right. So the money is working for you inside your life insurance policy.
Right.
And the life insurance policy doesn't really know that there's a loan out there. All that the life insurance policy knows is that the policy is collaterally assigned to a bank.
That's it.
The loan is actually with the bank. So the money's in the policy working, collecting the full dividend, while you've got a loan totally separate from the life insurance policy with the bank that you're paying interest only on. And the interest rate is significantly lower than the dividend rate on the policy.
And here's where I get the hang up with people, because a lot of times, we're taught you don't want debt, right? And obviously if you borrow from a bank, you're getting charged interest, that's a debt. And people want to stay away from that, like particularly if you're thinking about retirement or something. But what I try to help people understand is, wait a minute, if you're earning more and you've got underlying guarantees that you're earning more than you're getting charged, that means your money's growing every year. Right.
You're exactly right. Your cost of borrowing is negative.
Right. It's less than you're earning more than you get in charge. Your cost of borrow. Yeah, exactly. And so it's a positive arbitrage situation, which, like you brought up started to bring up in a previous segment. I have a lot of folks who are nearing retirement or are in retirement and want to supplement their retirement. And I have many clients using these policies. And the point is, you're accessing funds to supplement retirement, but they're picking up the positive arbitrage, which means they have more money to spend every year going forward.
Right, you're exactly right, and you're leaving the money in your retirement accounts to grow.
Right.
So and if anybody's paying attention to the stock market out there, it has been just rocking and rolling.
Right.
Since 2008, 2009.
Right.
So having the ability to keep your money in your retirement accounts appreciating for and growing for a longer period of time
right,
is going to be beneficial, especially when you're using the line of credit to supplement your cash flow in retirement and leave the money in the retirement account. I mean, we're talking about a really low interest rate on the line of credit.
right,
The money is you've got the positive arbitrage, right?
right.
From the life insurance policy, and your money is still in your retirement account working for you.
That sounds like a win-win-win to me.
Absolutely. And I always use my family as an example when I'm talking to people. This is, my dad was in the banking business for 40 years, and this is exactly how we have him set up to do his financial plan. My dad's 67,
Okay.
and he retired early at 58 years old, and he is supplementing his retirement income big time using the cash value line of credit simply because he doesn't want to start drawing on his 401k plan. He wants to own what's an IRA now, but he wants to leave the money in there working in the market for him because he knows the rule of 7 in the market.
Yep.
And the longer he leaves the money in there, the more growth he's going to get on his assets.
Right.
So he's using the cash value line of credit for the early years in retirement to supplement his income.
He's also deferring his taxes on that IRA down the road, kicking the can down the road further.
Exactly, and that's a huge important point that I like to talk about with people is, when you think about your retirement accounts, if it's an IRA or a 401k, you don't own 100% of that account.
Right.
You depending on your tax bracket, you probably own 70% of that account.
Mm-hmm.
So being able to leave that money in there and continue to grow and to continue to defer those taxes is going to help you out in the long run.
Right. Also, by creating the cash value policy with the bank line, you're creating a tax-free bucket of money.
Yes.
And And what I've been sharing with people more and more is, look, if you believe taxes may go up in the future, and certainly our current administration has talked a lot about raising taxes of all types, having that second bucket over here where you have a choice where you pull your money. If you have this, like you said, IRA 401k that's fully taxable versus a bucket over here that's fully tax-free, doesn't that open options up for you?
Absolutely. And a lot of times you'll hear financial advisors talk about the spigots that you can turn them on, you can turn them off, but you can also turn them up and turn them down.
Right.
Having the life insurance tax-free bucket with the line of credit against it allows you to control your spigots.
Right.
Allows you to turn them up, turn them down, turn them off if you choose to do that. Without it, you've got less control.
Yeah, basically dependent on what your taxable liability would be, what the tax brackets are, all that. We call it bracketology. We play the game, determine how much we pull from each bucket to determine how much tax is going to be owed that year.
Exactly right. And the cash value line of credit with the life insurance gives you the control over it as opposed to
the IRS
having all your money in one bucket where you don't have control.
Right. And I've seen differences of thousands and thousands of dollars of taxes yearly for folks because they have that option. They can play either way or combination.
Right. And if your money's growing in the market and growing in the life insurance policy, you're growing cash, you're growing assets that are going to cover those future taxes. Exactly.
The third thought process I run into with retirees, in particular with people thinking about that, is, okay, I'm going to take some money out of somewhere to supplement retirement income. Well, gosh, if I get a positive arbitrage scenario with those dollars, I'm going to have more money.
You're going to have more money, yeah. It's not costing you. People are scared of debt.
Right.
But it's not costing you anything to have that debt. And
right.
So, there's good debt and there's bad debt.
Right.
And this is one of those areas where this is really good debt because it's not costing you anything to own the debt. Now, you'll have to cash flow the interest, but is it costing you anything? No.
Right.
And what I tell people is when you're thinking about the difference between taking a policy loan or setting up a cash value line of credit, it is always in the policy owner's best interest to cash flow the interest on these loans. Because what happens is when you take out a policy loan, it feels really good.
Right.
Because you don't necessarily have to cash flow the interest. You can let that interest continue to grow in the policy.
Right.
But what we typically end up seeing is people take out these policy loans. It feels good. They don't have to pay the interest. And then that loan and their policy grows to a point where they've either got to pay it off or they're going to surrender the policy. In most cases, they're not going to pay that loan off. They're going to end up surrendering the policy, and that's a lose-lose for everybody involved.
No question.
So it is in the client's best interest to cash flow just interest only on the line of credit.
And
because then the loan stays the same.
And Russell, you're exactly right, because, again, given the scenario right now, most of the folks I'm dealing with are getting about 2.5% positive arbitrage. So literally, I use an example. If you, let's say you borrowed $10,000, okay, you would owe at 3.25% interest, $325 interest in a year, obviously, right? To the bank. But if you're getting 5.75 dividends at least, you're going to earn $575 of dividend in the policy. In other words, so you gain.
Yeah, your assets grew,
right?
And that's you're making a great point there, because it a lot of times people, when they think about cash flow, well, they think, oh, well, I'm paying for this. Well, no, you're not, because your assets are growing at a greater rate than you're paying out in cash flow. It just feels different.
It's a paradigm. It's a paradigm shift in thinking about money.
Behavior, yes.
Behavior, yeah, exactly. And once you realize that, like I liked what you said earlier, Russell, there's good debt and there's bad debt. I call it strategic debt and consumer debt. If you have to work to pay, here's the thing about debt I think people need to understand. This is Financial Literacy 101. If you have to work to pay the debt off, that's consumer debt. That's bad. That's what you can get in trouble with. That's what you want to reduce and get rid of as quick as possible. Strategic debt, and a great analogy I use all the time is, hey, if you bought a rental property, and this is something people understand, if you buy a rental property and then you rent that out and the rent you receive is more than the mortgage payment, can you build wealth that way?
Exactly, and that's what most business owners understand that concept.
Most real estate investors do too, for sure.
Exactly. Most real estate investors do too. And we're doing the exact same thing with the life insurance policy.
Right. And this is something that, frankly, anyone could take advantage of, whether the business owner, individual, or whatever, retiree, any of it, right?
You're exactly right. Anyone who has cash value life insurance, if you've got enough cash value in there, it is a no-brainer to have these in your financial cash value line of credit in your financial plan, because there's no fees to set them up. It will provide you liquidity and flexibility and unlock your money to be able to use it the way that you want to use it while you're alive.
Absolutely. Russell, I like to point this out too. A lot of times I get folks say, well, that sounds great, but I don't know if I can qualify for the insurance because I'm too old or whatever. Russell, last week I just qualified a couple who were age 74 and 78, and the numbers worked, and it worked well, and it was, and we compared it to them doing an annuity, and it was superior in terms of their return on their money.
Oh wow, that's a win-win situation for everybody.
Exactly.
And what I'll say to that, you won't know until you try.
Exactly.
I mean, it doesn't hurt anybody to find out.
Last thought, Russell. I think that's what we'll leave it on. Is if you've been listening to this, or it sounds interesting, contact me at yourpersonalbank.com. Let us run the numbers, show you how this works. We show you how the numbers work in terms of growing your money. We'll connect you with Coastal States Banks to show you how that you can then get the positive arbitrage. Russell, thank you for joining us today. It's been a pleasure.
Terrence, thank you for having me. This has been a great opportunity. I really enjoyed speaking with you.
All right. Well, folks, as always, stay tuned to the Your Personal Bank show and contact me at yourpersonalbank.com for more information. And as I always say, we'll leave it with this: as long as it's on our money, in God we trust.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.